Hey, good morning, everyone. Marty Mazzora here. It is the 3rd of May, 2025. This is your end of week market and I'll call it general conditions, or I guess I could say economic update. There's a whole lot going on in the world of markets, in the economy, both at home and abroad. And it's earnings season, so we have lots of information, things to think about from the commentary coming from various U.S. companies that we pay attention to. So I'm thinking what I'll do this morning is run through kind of the positives and the negatives in the data and in the earnings statements. And then we will hit the markets and look at what the charts are telling us right now. So probably with regard to just overall news headlines, which is what this market is pretty much 100% trading on these days, the news that the U.S. and China are both ready to sit down and start talking was just huge for U.S. and Asian equities at the end of the week last week, as you might imagine. I touched on breadth a couple of times over the last week or so, and I just picked on the days where the market was up, but the market really wasn't up. It was the big tech stocks that have been so beaten up this year, largely due to earnings here this last week, just really shooting up notably, when the rest of the market really wasn't. And one day we had tech stocks up 2 or 3%, seems like, and healthcare stocks down 2%. And consumer staple stocks down, 1% at least during the day that day. So again, tons of moving parts right now, lots to pay attention to. And I'll say it again, this market, the financial markets, are largely driven by, of course, they're always driven by flows. There's always liquidity to talk about, but it's the headlines that are guiding those flows. And then we get into the real dynamics or the weeds under the surface that have to do with leverage. I've talked a lot the last 2 or 3 years about what goes on in the options market. When people are resoundingly bearish and they're buying options or they're putting together option strategies like we do to hedge portfolios, for example, that would protect them in a hedging scenario from massive losses, or in a speculative scenario, make them a lot of money if the market goes down a bunch. Well, when they buy, for example, put options on the S&P 500, the counterparty to that, the options dealer, has to protect themselves in case the options buyer is correct, and they'll go short a bunch of securities or short the securities that they are insuring, so to speak, the ones that they are selling the puts on. In the case of the S&P, they'll sell index futures, for example. Well, when you get a little good news, and we talked about this, and this is part of the nature of these rip-your-face-off rallies that I keep talking about that happen during bear markets in particular. Largely it's because everybody was short because they were so pessimistic. And then, a little good news, a good headline comes out, and those shorts cover, because you can't be short a security when it's going up, or you could lose phenomenal amount of money. So covering means you now buy. When you short, you borrow something and you sell it. Well, you got to return it. So then they're buying. And then that buying creates a lot of extra oomph, if you will, to the upside for the market, right? And then what happens is if we really get sentiment strong and it flips and people start buying call options, betting on the upside, well, then the dealers have to hedge that risk as well, because they lose money, of course, because they're the counterparty if the market keeps screaming higher. Well, then they have to buy some derivative or directly the underlying, and that's more buying that can push it up. So you can get this impression, and you can read the headlines that everybody's just pouring into the market. Well, they are, but is it everybody because they're just crazy bullish? Or is there a certain element of it that is just the mechanism that revolves underneath all of this options leverage? And make no mistake, that's as big, if not bigger, now in this market than it's ever been. And of course, our concern is that it could send some false signals that the fundamentals and the environment really don't support sustainable massive rallies. People will get the impression that they do. And this is really the history of bear markets, if indeed that's where we are, is that you get these big rallies. It sucks people in, and then it breaks their heart later. And if I have time, I'll give you another example of that here. So anyway, so a lot going on, as I keep mentioning. And last week, China was big and tech earnings were big as well. As for inflation, data came in as expected. We had U.S. vehicle sales. They were good. They were 100,000 more than expected at 17.27 million. And make no mistake, folks, tariff-related buying lifted those sales big time. People clearly ran to the lots because they expected to be paying much higher prices if they waited due to the tariff pass-through, if you will. And of course, there was some indication that the surge was decelerating by the end of the month, probably due to, quote, tariff exuberance starting to dry up, and because of a drain, of course, to auto inventory. The Institute for Supply Management, these are components in our macro index, stayed below 50. The ISM Manufacturing Survey did at 48.7. I have loaded up all the details in my highlights, and I think I'll skip that because that would take too long. But just suffice to say that tariffs was far and away the number one stated concern. And these are surveys. This is survey as to manufacturing sentiment going forward. Verbal responses to how are your back orders, new orders, that sort of thing. The bottom line from the ISM, demand and production retreated and destaffing continued as panelist companies responded to an unknown economic environment. Prices growth accelerated slightly due to tariffs, causing new order placement backlogs, supplier delivery slowdowns, and manufacturing inventory growth. Pending home sales in March rose 6.1% month on month, well better than the 1% estimated. So that is a positive. And I will say this too, the soft data, which we'll talk about, that would be the sentiment data like the manufacturing that I just talked about, survey, and consumer surveys are really rolling over negatively, which suggests that if that sentiment continues to wane, well, then this hard data should wane in the coming months as well. Amazon reported their earnings, and with regard to their consumer business, they noted that they've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact. We also have not seen the average selling price of retail items appreciably go up yet. Some of this reflects some forward buying we did in our first-party selling, and some of that reflects some advanced inbounding our third-party sellers have done. But a fair amount of this is that most sellers just haven't changed pricing yet. Microsoft, it was a record quarter driven by continued strength in Microsoft Cloud, which surpassed $42 billion in revenue, up 22% in constant currency. Cloud and AI are the essential inputs for every business to expand output, reduce costs, and accelerate growth. Within ad revenues, the online commerce vertical was the largest contributor to year-over-year growth. From MasterCard, consumer and business sentiment has weakened, primarily due to concerns around the impact from tariffs and geopolitical tensions. On the other hand, so far this year, the fundamentals that support consumer spending have been solid, and our drivers are generally stable. From Visa, we have not seen any signs of overall consumer spending weakening, while spending growth differs among consumer spend bands. With the most affluent growing the fastest, all spend bands remain resilient and consistent with past quarters. Live Nation, on broader demand trends in light of everything that's going on, it's a question every CEO gets asked. Are you feeling the consumer pullback at all? We have not felt it at all at Live Nation. They book concerts, etc. Bookings holdings at the start of Q2. We are currently seeing stable levels of global leisure travel demand despite rising geopolitical and macroeconomic concerns. Royal Caribbean, as we look across the current macro landscape, we recognize that there is heightened uncertainty. However, research, including the direct surveying of customers, continue to show that propensity to cruise remains encouraging. Consumers are still prioritizing experiences, planning to spend more on them this year, and are seeking value that we are well positioned to offer. So we got the jobs number Friday. Payrolls grew by 177,000. That was 39,000 above expectations, but the two prior months were revised down by 58,000 combined. ADP, the payroll service, they reported their job number on Wednesday. They said that just 62,000 private sector jobs were created versus their estimate of 115,000. Challenger, Gray, and Christmas, they do work on the labor market as well. Quote, though the government cuts are front and center, we saw job cuts across sectors last month. Generally, companies are citing the economy and new technology. Employers are slow to hire and limiting hiring plans as they wait and see what will happen with trade, supply chain, and consumer spending. The number of job openings in March fell to 7.2 million, down 376,000 month on month to the least amount since last September and the second lowest amount since early 2021. The hiring rate, though, held at 3.4%, the fourth straight month at this pace. The quits rate ticked up by 0.1% to 2.1%. With regard to jobs, folks, make no mistake, the logistics space probably had to hire people recently in this last month or so because of the massive ramp up of buying ahead of the tariffs. In fact, from what I read from another source, most of the respondents to the survey came in the earlier part of April. And so it would make sense that the jobs numbers held up. It would make sense that the spending numbers held up, certainly among businesses, because of the concerns over tariffs. In terms of jobs, from a logistics standpoint, of course, they had to deal with all of the flow of goods. We had a massive trade deficit in the last quarter, which led to a contraction in GDP, and that is not the recession we're talking about, by the way. That'll be corrected in the next month, I'm sure. And it was massive last month because of us buying so much stuff to get ahead of tariffs. And it speaks to probably the relative strength of the U.S. consumer, U.S. economy at the moment anyway. We have our concerns, as I keep sharing with you. The Conference Board's Consumer Confidence Index fell to 86. In fact, I did load that one up right here, from 93.9, with most of the decline led by the expectations component, which is now at the lowest level since 2011. One-year inflation expectations jumped a full 100 bips to 7% from 6%, the highest since November of 2022. Signs of slowing hiring activity was apparent here again. So this is the soft data. This is what people are saying they're expecting or they're experiencing. It doesn't necessarily show up in the hard data yet. This is our concern about the months going forward. Those that said jobs were plentiful fell to a 7-month low. Those that claim they are hard to get, jobs are hard to get, rose to a 6-month high. When looking out 6 months, those who expect more jobs fell 3 points to 13.7, the least since last June. Those who expect fewer jobs rose to the highest since 2009, and that was during the great financial crisis, or right when it was bottoming. Income expectations softened too. There's more, but I think you get the gist. March savings rate fell to 3.9%, hovering near multi-year lows. You can see that here on our chart. Apple, during their earnings call, said that assuming the current global tariff rates, policies, and applications do not change for the balance of the quarter and no new tariffs are added, they estimate $900 million in addition to their costs. McDonald's, we entered 2025 knowing that it would be a challenging time for the industry due to macroeconomic uncertainty and pressures weighing on the consumer. During the first quarter, geopolitical tensions added to the economic uncertainty and dampened consumer sentiment more than we expected. There's a lot there that I highlighted, but essentially, let me just jump to, they're really seeing the lower income cohort and the middle income cohort cut back on their spending, and they're now even starting to see it on their higher income customers. Starbucks, their Q2 results are disappointing, especially measured by earnings per share. Behind the scenes, we made a lot of progress, so they're sounding optimistic about the future. Domino's Pizza, carryout business comps were up 1%. Delivery was down 1.5%. Delivery business continues to be impacted by macro pressures that are impacting the low-income consumer. Hilton, broader macro uncertainty intensified in March, which pressured demand, particularly across leisure. From Caterpillar, the tariffs which have been announced and implemented this year are currently estimated to be a cost headwind of about $250 to $350 million. Stanley Black & Decker, price increases will be necessary in the U.S. market due to current tariffs, and we have implemented a substantial increase for in April. UPS, as we moved into February and March, uncertainty surrounding global trade policies and other matters led to a drop in consumer confidence and muted demand from some enterprise and small and medium-sized business customers. As a result, the decline in U.S. average daily volumes for the months of February and March were higher than expected, so the decline was higher. Cisco, they supply restaurants. In addition to the effects of adverse weather in the quarter, consumer confidence has been shaken by the recent trade policy and tariff negotiations. The decline in confidence levels gives us concern for the full year ahead. Colgate-Palmolive, the first challenge is the weaker consumer you've heard throughout the week. While a slowdown in category pricing was always built into our assumptions for 25, the macroeconomic and consumer uncertainty we saw in Q1, not just in the U.S., but also in other countries around the world, had a negative impact on volume growth and therefore category growth in the quarter. I'm just going to stop there. So I'm not here to tell you that it all sounds bad. I'm here to tell you that our concerns are that the sentiment looks like it's rolling over pretty hard for obvious reasons, and the hard data will follow. I think I talked here in the last week or two about the lack of ships leaving ports in China, not just to the U.S., but everywhere. So that's going to be concerning potentially in terms of what the shelves are going to look like in the coming months, and of course that's not going to be good for sentiment either. Bottom line, I think it would be remiss of us and irresponsible to say that recession risk still is not uncomfortably high right here. And as I've looked at in the charts, and I may show you again here today, this market is just not priced for that. The equity market, the financial markets aren't. And that's where we need to continue to stay on our toes. We've had a really good year so far this year relative to what's been going on in, say, the U.S. equity market, but we are taking absolutely nothing for granted. That relative performance is thanks to things like commodities like gold and non-U.S. securities and that sort of thing, and still keeping a really notable chunk in short-term treasuries. And that just is a reflection of our concern. And of course, we continue to hedge with our option strategy. Okay, so let's just take a quick look at the stocks. Thank you for hanging in there this long, those of you who are still with me. So the S&P 500, remember we drew these Fibonacci retracements. We found a little bit of resistance right here at the 50-day, but we pounded through that. 62%, these are the three keys, blew above that on Friday and sit just a little bit below the 200-day moving average. If this is indeed a bear market, you're going to run into a wall right there. And I'll show you some history here when we look at the NASDAQ 100 ETF. So we still have this 50-day below the 200-day, which is a bearish signal, and the 200-day it looks like it's trying to regain its upside momentum here. That would be wonderful from a technical perspective. It's not rolling over like it was, and that's because of this rally right here, which has been quite the epic rally. Periods like this, historically, like 90% of them happen during bear markets. And again, that's that phenomenon that I keep talking about. Doesn't mean this is a bear market, doesn't mean we won't get to all-time highs, but we tend to see the biggest rallies during bear markets. Remember I said in here we were 100% expecting, in fact, we gamed it a little bit and did well with it. We were expecting the market to bottom right in here. And I said the ensuing rally, even if it's a bear market rally, could go weeks, even months. And I've shown you that on the chart. And I think I'm going to show you a little bit more here in a second. The QQQ, the ETF that tracks the NASDAQ 100 index, it literally hit the 200-day moving average. Remember I said if this is a bear market, we're going to see some real resistance right here. And I want to show you something here historically in a second. So we have retraced right at that 62% retracement. These are highlighted because they're the most important ones. And for technical analysts, you can see this 200-day does have that rollover look, which is negative. And again, that's where we found resistance here yesterday. Still a nice up day, but notably off of where it peaked right in there. Okay, so here we have, losing a 200-day moving average, it rolling over. You got your 50-day crossing below the 200-day, the so-called death cross. And here we are testing that. Absolutely, unequivocally, what tends to happen during bear markets. Who knows? Maybe animal spirits come back. Maybe the trade war goes away. Maybe the soft data gets better, and maybe we don't have our recession, and maybe this was it. That's certainly within the realm of possibilities. But the data right now and the history and the technicals, I'll say it again, would make it very irresponsible of us to assume and to act as if that's the case right here. So we're going to go back, and I'm going to show you kind of a scary period back in 2007, 2008, with an eerily similar look. So here you can see the market taking, and here we bottomed with a 25.59% decline, right? And we've seen so far off of that a 22% rally. Pretty strong, convincing rally if you want to be bullish, I would say, right here. Okay, so let's run it back to, I'm just going to change the starting date to a year back from this day in 2008. And as you can see, 25.46% decline, right? I think it was 25.50 or something currently. And at that date, we had seen a 20% rally, right? As opposed to 22 so far. So let me just add a month onto the end of that. And by the way, here we are breaking through the 200-day moving average, right? And so ultimately, if I do it here, we got a, 22%, 23% rally, very much like we're seeing right now. But look what happened. We actually broke through the 200-day, retested it, found support, came up, tested it again. This is looking very, very bullish, folks. And I know, I lived it, right? That people were thinking that we're back in business and the market's going to go back to new all-time highs. So let me just fast forward to March of the next year. Well, here's what we were looking at just now, right? And you can see by June, and this was a 3-month rally. By June, we lost the 200-day moving average again, came down, retested it, and then we had a false breakout, and then the rest is history, and it was a 57% decline before it finally bottomed for good. So, folks, my point is that these retracement rallies, very, very impressive. In fact, let's see how far it went. It retraced, right where we are right now, 62% of the fall. And I am not predicting that this is how this is going to play out. All I'm saying, folks, is that a lot of macro concerns right now. What we had in here was a mortgage security and residential real estate bubble, a debt bubble, if you will. We don't have that today. What we have today looks more like the 99 tech bubble scenario. We didn't have super high stock valuations in here. We had an economy that in a very important space was way out over its skis, way heavily leveraged, and it was devastating to people, that recession. That is not what we expect here, by the way. But what I'm showing you is just the action that happens in bear markets. What we have now is an overvalued market historically. We have a huge concentration in one particular sector, like we did in late 99, early 2000s. And we have consumers who are all loaded up in that space. And we have the threat of a, we think, mild recession. And that's what we had in 2002, was a very mild recession. But we still had stocks going down 50%, the NASDAQ going down 80%. So again, one more time, and forgive my being so redundant, all I'm saying is nobody knows the future for sure. There are elements of the current setup that are concerning across the board, the macro data, the technical setup, and so forth. So let's just keep our wits about us and be prepared for anything and be willing to change our tune when the data, etc., demand that we do or allow us to, so to speak. Okay, so I have, breadth indicators loaded up here. This is the percent of members in the S&P above their 50-day moving average. The fact that the S&P is now above its 50-day moving average and just barely over half of its members are, that's not a great sign. Worse yet, on the 200-day moving average, we're almost there, but only 43% are above that. So this is not a party so far that everyone is attending, so to speak. We usually look at the dollar. I'll just do that quickly. The dollar is still kind of in this range right here. Had a big day a couple days ago, off a bit yesterday. Not a bad looking chart. Could see the dollar get stronger here going forward. This big jump in yield yesterday was not a headwind for stocks. That reflects the relatively okay labor report. It was not the doom and gloom that says recession is coming. So people sold bonds, rates went up. Doesn't make it easy for the Fed to cut rates, of course, and that could be problematic as we go forward. And then gold, remember up in here, we said gold is due for more than a 1% to 2% correction. It's down about 7% from the peak right here. We're hedging it. It's kept us from realizing all of that 7% loss so far. I'm concerned that gold could go further. It tends to correct further when it gets this far out over its skis. Long term, I think gold is going to be a very important thing to own in portfolios. I think we already looked at consumer confidence and the savings rate. So, folks, that was a long one. And thank you. I appreciate those of you who have stayed with it this long. Hope it's helpful information. And it's really targeted to you clients, just so you know what we're thinking and the whys and the wherefores of the confirmation statements that you get as we continue to adjust as this very uncertain time plays itself out. Take care. Hope you have a great weekend. Bye-bye.